A market that punishes failure allocates capital efficiently. A market that socializes failure allocates capital politically. That is not an ideological statement, it is a mechanical one. The price system functions because loss is real. When a business makes poor decisions, capital flows away from it toward better managed competitors. When a bank extends credit recklessly, it absorbs the default risk. The prospect of failure disciplines behavior before the failure occurs. Remove that prospect through the credible expectation that the state will intervene before losses become terminal, and the entire behavioral calculus of the financial system changes. This is what bailouts actually do, not in the moment of intervention, which is always framed as an emergency measure to prevent systemic collapse, but in the years and decades before the intervention, when every major financial institution, creditor, and counterparty is making decisions with the implicit understanding that certain entities will not be permitted to fail. The public narrative around bailouts focuses on the crisis moment, the urgency, the scale, the justification. What it rarely examines is the structural transformation that occurs in market behavior before the crisis. You cannot understand why financial systems produce recurring crises of escalating scale without understanding this mechanism. The bailout does not begin when the check is written. It begins when the expectation is established. The economic term for the behavioral distortion produced by bailout expectations is moral hazard. The concept originates in insurance theory. When an actor is insulated from the consequences of a risk, they tend to take more of it. A bank that operates without a credible expectation of government rescue will price its risk appetite against its own capital base. Leverage ratios reflect the cost of potential insolvency. Loan underwriting standards reflect the real probability of default. Counterparty selection reflects genuine credit analysis. The bank's survival depends on getting these calculations right, so the incentive to get them right is structurally enforced. A bank that operates with the expectation of rescue, through explicit guarantees, deposit insurance structures, or the demonstrated historical behavior of regulators, faces a fundamentally different incentive structure. The downside of excessive risk-taking is truncated, the upside is not. This asymmetry produces a rational bias toward more leverage, lower underwriting standards, and greater counterparty concentration than the bank's actual capital position can structurally support. The first concrete example is the savings and loan crisis of the 1980s. The savings and loan industry operated under federal deposit insurance that guaranteed depositor funds regardless of the institution's investment decisions. This guarantee, combined with deregulation that expanded permissible investment activities, produced a wave of speculative real estate and junk bond investments that the underlying capital of these institutions could not absorb. When the investments failed, the Federal Savings and Loan Insurance Corporation was insolvent. The eventual resolution cost taxpayers an estimated $130 billion in direct government expenditure, with total losses across the industry reaching significantly higher. The moral hazard mechanism was not incidental to this outcome. It was the primary driver. The second concrete example is the period preceding the 2008 financial crisis. The structured credit market expanded dramatically through the mid-2000s under conditions where major rating agencies, the largest investment banks, and government-sponsored enterprises all operated with some form of explicit or implicit protection from terminal failure. Fannie Mae and Freddie Mac, the two largest mortgage securitization entities in the United States, carried an implicit government guarantee that allowed them to fund mortgage purchases at artificially low borrowing costs, systematically underpricing the credit risk they were accumulating on a multi-trillion-dollar scale. When Treasury Secretary Henry Paulson and Federal Reserve Chairman Ben Bernanke testified before Congress in September 2008, requesting emergency authorization for the Troubled Asset Relief Program, a $700 billion intervention, they were describing the acute resolution of a structural problem that had been building for years. Under conditions of moral hazard that the regulatory architecture had itself created and sustained. The explicit financial consequence of this incentive structure is asset price inflation driven by leverage that would not exist in a market where failure risk was fully priced. Risk premiums compress, yield spreads narrow. Capital flows toward complexity and opacity rather than transparency and fundamentals. Because complexity generates fees and opacity, obscures the true risk profile from counterparties who have their own reasons not to look too closely. The structural pattern of crisis, intervention, and the moral hazard cycle that follows is not a modern phenomenon. It is a recurring feature of monetary systems that couple private risk-taking with public loss absorption. The first historical reference is the Panic of 1907 in the United States. A speculative run on trust companies, financial institutions that operated outside the formal banking regulatory structure, created a liquidity crisis that threatened to cascade through the broader financial system. The resolution came not from a government institution, but from J.P. Morgan, who organized a private consortium of bankers to provide emergency liquidity. The structural consequence of this episode was the creation of the Federal Reserve System in 1913, an institutionalized lender of last resort. The creation of a permanent institutional backstop, while solving the acute problem of liquidity crises, also permanently altered the risk calculus of every financial institution operating within its reach. The second historical reference is the long-term capital management collapse of 1998. LTCM had accumulated positions with a notional value estimated in the hundreds of billions of dollars, funded by leverage ratios that would have been structurally impossible without the willingness of major financial institutions to extend credit on those terms. When its arbitrage strategies unraveled following the Russian sovereign debt default, the Federal Reserve Bank of New York facilitated a private sector rescue organized among LTCM's major creditors, preventing disorderly liquidation without a direct government expenditure. The then president of the New York Fed publicly acknowledged the systemic risk rationale for the intervention. The signal sent to the broader market was structurally identical to a direct bailout. Entities of sufficient size and interconnection would not be permitted to fail in a disorderly manner. Each episode of intervention, regardless of its stated justification, narrows the effective risk perimeter for large financial institutions and expands the implicit public liability for private risk-taking. The system does not reset to neutral after each crisis. It resets to a new baseline of higher leverage, greater complexity, and more concentrated systemic risk than existed before the intervention. The measurable effects of sustained moral hazard in financial systems are visible across multiple observable economic patterns, none of which require a conspiratorial framework to explain. They are the predictable outputs of the incentive structures described above. The first observable pattern is the secular compression of credit spreads in the periods between crisis episodes. Credit spreads, the additional yield demanded by investors to hold riskier debt relative to a risk-free benchmark, reflect the market's assessment of default probability. In a market where the expectation of intervention suppresses the perceived tail risk of major financial institution failure, credit spreads systematically underprice the true structural risk of the instruments they are attached to. This mispricing is not irrational within the context of the incentive structure. If you expect the government to backstop the system before losses become catastrophic, pricing in catastrophic loss is leaving money on the table. The rational response to the expectation of intervention is to compress spreads, extend duration, and increase leverage, which is precisely what the credit markets have done in each expansion phase of the post-2008 cycle. The second observable pattern is the growth of too-big-to-fail concentration in the banking sector following each crisis intervention. The 2008 crisis resolution involved the facilitated acquisition of Bear Stearns by J.P. Morgan Chase and the acquisition of Wachovia by Wells Fargo, transactions explicitly structured and encouraged by regulators to prevent disorderly failure. The structural outcome was a banking sector that emerged from the crisis more concentrated than it entered it. Institutions that were already considered systemically important became larger and more systemically important. The Dodd-Frank Wall Street Reform and Consumer Protection Act, signed in 2010, formally established the category of systemically important financial institutions, entities subject to enhanced regulatory oversight precisely because their failure would pose unacceptable systemic risk. The formal codification of this category did not eliminate too big to fail. It institutionalized it. The systemic risk concentration produced by each bailout cycle creates the structural preconditions for the next one at a larger scale, with greater interconnection, and with more public liability embedded in the backstop structure. The positioning implication for a rational actor is not to predict when the next crisis will materialize. It is to recognize that the financial system's risk architecture is structurally misaligned, that the stated risk of instruments does not reflect the true risk distribution, because that distribution has been deliberately altered by the expectation of intervention. Assets that exist outside this system, whose supply is not expandable by institutional decision, whose risk cannot be socialized through regulatory action, and whose value is not contingent on the solvency of a counterparty, carry a structural premium that conventional risk models do not capture. The architecture of moral hazard is not hidden. It is documented in congressional testimonies, in regulatory frameworks, in the formal designation of institutions as too important to be allowed to fail. The structural distortions it produces, credit spread compression, leverage accumulation, concentration of systemic risk, are observable in public data across every cycle in which the expectation of intervention has been operative. What is less widely understood is the directionality of the effect over time. Each intervention does not simply resolve the immediate crisis. It recalibrates the baseline expectation for the next cycle. The financial system that emerges from each bailout is one in which the implicit guarantee is larger, the covered entities are bigger, and the moral hazard is more deeply embedded in the behavioral assumptions of every participant. You do not need to assign corrupt intent to any of the individuals involved in these decisions to understand the structural logic. Henry Paulson, requesting TARP authorization in 2008, was responding to a genuine systemic emergency. William McDonough, facilitating the LTCM resolution in 1998, was preventing a disorderly market event with real potential for cascading damage. These were rational responses to acute structural failures. The problem is not the intentions of the actors in the crisis moment. The problem is the incentive environment that the pattern of responses creates for every actor in every subsequent non-crisis period. Understanding this structure does not require anger, it requires clarity. The system produces recurring crises of escalating scale, not because the individuals operating within it are uniquely reckless, but because the incentive architecture systematically rewards risk accumulation and socializes its costs. That is the machine. Understanding how the machine works is the prerequisite for positioning outside its failure modes. Capital that understands this structure allocates accordingly toward instruments whose value is not contingent on the continued stability of a system, whose stability is itself contingent on the perpetual expansion of the backstop. The discipline is in recognizing what the data is describing, not in reacting to what the narrative is prescribing. This is 21 Protocol. Freedom is not a feeling, it's a structure. If you don't build yours, they will build over you.